Stagflation is a term that combines stagnation and inflation, describing a situation where the economy experiences slow growth, high unemployment, and rising prices all at the same time. Right now, there are increasing signs that the US economy could face this as a risk, as both inflation and growth indicators are flashing warning signals. In January 2025, US retail sales dropped by 0.9%, the largest decline in almost 2 years. This was following a strong holiday spending season as well, and many people blame this decline on severe weather and winter weather, which kept people at home. Auto sales dropped by 3%, and online retailers saw sales decline by nearly 2%. The only bright spots were gas stations and restaurants, which saw slight increases. While the economy grew strong in 2024, the outlook has become more uncertain, particularly with lingering inflation, high interest rates, and a potential shift in policy under the new Trump administration. The stock market reacted with a slight dip in major indices, reflecting concerns about slowing consumer spending. And inflation is proving to be more persistent than expected. It's not transitory. Wholesale prices in the US rose significantly in January, with the PPI, or the Producer Price Index, increasing by almost 0.5%, hitting an annualized rate of 3.5%, the highest in almost 2 years. With rising costs for oil and food, much of that blamed on a bird flu outbreak, have contributed to these increases. Core wholesale inflation, which excludes food and energy, was also up almost 3.5% year over year. And this follows recent reports that consumer prices also rose more than expected, meaning the Federal Reserve may delay cutting interest rates for longer than the market had hoped. High borrowing costs have already affected home buyers and businesses, which is slowing economic growth, but inflation remains stubbornly high. Donald Trump has suggested pairing new tariffs with lower interest rates. He's even told Jerome Powell to lower the interest rates, but I don't think that's quite how it works. Many economists warn that this could just backfire. Tariffs are essentially a tax on imports, which raises prices and can contribute to inflation. When Trump previously imposed tariffs in 2018 and 2019, economists alleged that it cost American consumers around $1.4 billion per month. If tariffs return, they could force the Federal Reserve to keep rates high instead of cutting them like everyone wants, making borrowing more expensive and potentially leading to a recession with elevated prices, a classic stagflation scenario. The Federal Reserve's response to the latest inflation data suggests that they'll maintain their cautious approach, and that we might not see any rate cuts this year at all. While Fed Jerome Powell downplayed the higher than expected consumer price index report, he acknowledged that inflation is still running above the Fed's 2% target, which is some arbitrary target that just means nothing. Powell emphasized that the Fed considers long-term trends rather than individual data points, but economists now believe rate cuts may be postponed for longer than previously expected. There's been no indication at all that the Fed would raise rates again, but with inflation showing resilience, the central bank may need to keep monetary policy restrictive for longer than markets had originally hoped for. So it still could be on the table. There's also global concerns about stagflation risks. The Bank for International Settlements has warned that tariffs and a stronger US dollar could fuel stagflation pressures worldwide. Tariffs increase production costs, which not only raises prices domestically, but it also disrupts global supply chains, further exacerbating inflation. Meanwhile, a stronger dollar can hurt emerging markets by making debt repayment more expensive, and it could lead to broader financial instability. Gold and silver prices have been surging as investors seek protection against inflation and economic uncertainty. Historically, precious metals have been a safe haven during periods of stagflation, and the growing risk of slow growth combined with high inflation has driven demand for these assets. Gold recently reached a record high, and analysts believe it could continue climbing if inflation numbers remain elevated and central banks delay interest rate cuts. Investors are also turning to other commodities as rising prices in energy and raw materials make traditional stocks and bonds less attractive in a stagflationary environment. They're also just generally unaffordable right now. The stock market is already starting to reflect some of these risks. During the stagflation of the 70s, major stock market indices struggled, and some analysts fear that a repeat of that scenario could be devastating for retirement portfolios. While small cap and micro cap stock performed relatively well during the last stagflationary period, larger companies faced difficulties as inflation eroded earnings. Some investors are now looking at alternative assets like commodities and real estate as potential hedges against the possibility of prolonged economic stagflation with rising prices. The bond market is also showing huge signs of concern. Inflationary pressures are making it harder for the Federal Reserve to justify cutting rates, and long-term interest rates remain elevated. Investors had initially hoped for multiple rate cuts in 2025, but those expectations are now being adjusted downward. The bond market has reacted by pushing up yields even higher, which could further tighten financial conditions and slow down economic activity. Energy prices are another factor that could worsen stagflation risks. While oil prices have remained relatively stable in the recent months, any geopolitical disruption or supply shock could send prices surging again. A spike in oil prices would raise transportation and production costs across industries, pushing inflation even higher while simultaneously reducing consumer purchasing power. The US is less dependent on foreign oil than it was during the 1970s, but energy prices shocks remain a key risk factor for economic and inflation growth. Wages are another piece of the puzzle. On one hand, wage growth helps workers keep up with rising prices. But if wages rise too high, too quickly, they can feed into inflation by increasing costs for businesses. Recent data has shown that wage growth has remained strong, particularly in the services sector where employers are still struggling to fill job openings. However, if businesses respond to higher labor costs by raising prices, it could prolong inflation and force the Federal Reserve to keep interest rates elevated for longer and cause a wage price spiral. For businesses, stagflation presents serious challenges. Companies that rely on discretionary spending, such as retail, travel, and hospitality, may see their profits squeezed as consumers cut back. Meanwhile, firms with high debt levels could struggle as borrowing costs remain elevated. On the other hand, companies in sectors like energy, agriculture, and commodities could benefit as rising prices for raw materials boost their revenues. For consumers, stagflation means higher prices, higher borrowing costs, and a potentially weaker job prospect. Credit card debt has also reached record levels, and with interest rates at multi-decade highs, carrying a balance has become even more expensive. Mortgage rates remain elevated, making homeownership less affordable. Rent prices have also continued to climb, further straining the housing budgets. If job growth slows and layoffs increase, many households could find themselves in a financial squeeze. The economic backdrop is becoming increasingly complicated. Consumer spending is slowing, inflation is proving stickier than expected, and the policy environment is uncertain. If tariffs return, the combination of trade restrictions, higher prices, and high interest rates could create a perfect storm for stagflation. The Federal Reserve is caught in a difficult position, needing to balance inflation control with supporting economic growth. But their current stance suggests they're prioritizing inflation containment over stimulating the economy. With these risks in mind, it's important for investors and consumers alike to be prepared for a period of uncertainty. Those nearing retirement may want to reconsider their portfolio allocations, ensuring they have exposure to assets that can withstand inflationary pressures. Consumers should also be mindful of how rising prices and economic slowdowns could impact their financial planning. While the labor market remains relatively strong, there are signs of weakening demand in certain sectors which could lead to higher unemployment in the coming months, not to mention those huge downward revisions. The risks of stagflation are not just theoretical, they're starting to show up in the data. Slowing consumer spending, rising inflation, and policy uncertainty all point to a more challenging economic environment ahead. While the economy has remained resilient thus far, the next few months will be crucial in determining whether we're heading towards a period of prolonged stagflation or if policymakers can turn this boat around and get the economy back on track. If you enjoyed this video, please give it a like, subscribe, and leave a comment down below telling me what you think. Do you think we're going to run into stagflation, or do you think everything's going to be fine? Thank you so much for watching, and I'll see you next time.